Hello and welcome back to another weekly forecasting video where we go through the Forex major markets and we depict a bias within the markets. So jumping straight into the dollar index this week, we're going to make this, pretty quick just to give you guys some information as quickly as possible. If I delete this and I delete this, we were marking out on the charts. We did a trade breakdown video in my previous video where we swept the previous month's low, took that liquidity with a strong close on the daily candle here. And then we displaced higher, leaving these fair value gap retracements. So from a technical standpoint, I am now looking at this as the next swing point in price that should hold as we have come from a fair value gap. Mark this range high to low, or low to high I should say, and then we are now looking within this retracement area to go again and expand higher. So we still do have this high on the cards that we can mark out as a potential draw. However, this draw right here would be where I'm casting my eyes for the next area in price to target. So just delete that so it makes sense. Look, we're looking at optimal trade entry of this range right here. We've already had a strong close again from this fair value gap area. Again, anywhere within this area we do have mitigation block. All these consecutive down candles create an order block. Displacement higher, leaving fair value gaps, volume imbalance. This is a very sensitive area in price if the bias to go higher should hold. So this is a good trading idea from my perspective. So if we take this idea from the dollar, because we're not trading the dollar, obviously, we're just using this as a main indicator to see where other pairs should trade. We can take this to the EURUSD. So as you can see, the same thing here. We've marked out previous month's high. We've swept that, displaced, create failure swing highs. Keep trading lower. We took a trade actually in the past couple of weeks from this high right here. We got in at the 75% retracement level and we then entered to short this range right here. And then it's pretty much from this high to this low. We do have, relatively equal lows right here. So again, this is more resting liquidity for our trade to come down into this area and take. And we've come back up into this range. This took quite a lot of heat. However, the order block seemed to be where the price wanted to react from. We've had a strong daily close on the Friday last week within this range. So we're now back at the optimal trade entry level, the 6.2 retracement level. And then now we've opened the next daily candle just about an hour ago for this. Sorry, the next weekly candle has now opened. So pretty much from a technical standpoint, there is nothing more to do. Again, as we said with this trade, you just have to see your model and then know that it's got a higher probability of going within your direction and then manage the trade effectively. If I start seeing a good positive close towards the 25% level, I will look to then shave to break even within this area. That's pretty bread and butter, to be honest. It's a failure swing. We've had this daily candle sweep the previous day's high, close much lower than expected. Which shows good signs and intent of reversing, at least coming back towards this range. So that's where we will be monitoring early on in the week. Now, from GBPUSD, we can have a look at the same thing. The range, if I just mark out what we marked out, has been much more resistant to going lower. We've come up. We've not really had the same daily candle close as we did on the euro, the positive confirmation, I should say. So therefore the euro to me looks like the better pair at the minute for shorting. Other than that, that's pretty much it from positions that I'm currently looking at. It's nothing too based in the fundamentals due to the government shutdown in America. We're not really getting the data reports that we want. So this is where I will rely on a technical model in order to engage within the market. I covered this quite a lot last week. I don't want to go too much into it. Just to cover the same content for needless sake when it's available for you guys. But when a technical model does present itself, when it's there and it gives you the opportunity, there is nothing more to think about. Anything else is just emotion. If this trade does end up coming lower, then it's not because I haven't thought about the analysis. It's not because I haven't seen the reactions in price that I wanted to. And it's not because it doesn't make sense. Everything's been ticked off. And whenever I'm in this point of view in the market, I'm happy with the outcome no matter what, because I know I've followed my rules effectively. I've implemented an edge within the market that I know should repeat for myself personally over time due to the data I've collected. I always will say, go and test your model, go and see what you see, and then get some stats and come back with those stats to see how you can positively affect your trading going forward. That's a big takeaway. You know, these weekly commentaries are made in a way to help people depict what I'm seeing, to show some of the ideas, maybe the confluences I'm using to build those trading ideas, and then hopefully you guys can take something away from how I build my bias, how I see things in price, and maybe implement it in your own strategies or your own sort of holistic view on the markets. If we move across to gold, we'll just cover gold pretty quickly. We had a retracement on the Friday. However, it doesn't really seem to be doing much. We've seen such expansion in gold over the past couple of years. It's just been shooting higher and higher and higher. I think it's mainly due to the uncertainty around all the economies in the world since COVID. We've had a lot of sort of economic problems come up, labour market in America. We've had inflationary problems all over the world, and tensions have been heating up in different places, which when investors feel that tension, they always want to put their money in something that's a safe haven. The dollar index hasn't really provided that, if we just go back to the dollar, because of all the uncertainty over the tariffs and stuff and war. So obviously investors have been taking money out of the dollar. And if this safe haven isn't having the money, then other areas will get it. It's market flows, it's market pricing. So the dollar index, the gold market does seem to be a place where people and investors are heavily interested in buying up, which means higher prices will come. To be honest with you, I never position myself in gold, but it's just something to monitor long term, just to sort of see how, just because you don't trade something doesn't mean you can't use it as a confluence to any trading ideas. If this is going higher and higher, then the sort of smart money, the banks are buying up gold on a huge institutional level, which tends its hand to the fact that people aren't feeling overly zealous about being risk on within the markets, which means they're sort of choosing a safer asset that's got finite resource that will always hold value, just to sort of subdue that volatility that might come about. If we look at crude oil has been taking a huge dive in pricing, which should actually stimulate production within economies, which is good. And if production does get stimulated within different economies, then we could see that as a fact of a lesser reason for a rate cut from the dollar index, as when they've got inflationary issues, and if this stimulates higher output and production, then there's less reason to lower those rates to do the same thing. So therefore, I believe now, we've known for a long time that the dollar index has been looking at cutting rates, and this has fully been priced in. About a month or two ago, I was looking at this trade here on CHF. I've still got it on actually, because I haven't traded it since. We shorted the market here, and we rode this sort of sentiment that the rate cuts were coming, and then FOMC did come on this day, and sort of seems to be that any further rate cuts have been priced in unless there's something more shocking that comes out. If we go to the S&P 500, we did have that shock on the Friday last week where we covered that a bit. That was due to the fact that there was the tariff announcement on Twitter that Trump said he was going to put a tariff on China. However, that has since been a bit iffy of whether that's actually going to happen. So we've pretty much seen a full recovery on the S&P 500. So I don't really see any reason to not make all-time highs here in the near future, seeing as this is pretty much fully recovered from this daily candle. So a lot of things are noise in the market, but you sort of have to see through that and look more long-term. If we do look at the bonds, they've been trading lower, but we've again swept this sell-side liquidity. We've had a strong close higher, so it's showing sort of resiliency to just falling lower. Same with the US 30 years, exact same thing, which is nice to see correlation within the bond markets on the daily closes, just on a longer and a shorter term. So they all look in line to maybe at least move up in towards this premium, and maybe we can even go a bit higher than that. And then other than that, that's pretty much everything I've been considering over the past week and now in the up and coming week. If I just quickly pull up the Forex factory calendar, we don't have much news on the Monday. We don't have much news for USD on the Tuesday or the Wednesday. I mean, pretty much because of these government shutdown, there's been a lot of news releases that just aren't going to come out. So it's important to just sort of not really rely on news drivers so much, because they can just instantly be taken out. The interesting thing though is I think CPI has been moved to the Friday because they basically need to get that report out, and I'm pretty sure that is coming on the Friday. So if inflation does come out hotter than expected, then I would expect that the DXY is going to rally even higher than where we are currently right now, which would be an extra confluence for this euro short. Other than that, guys, that's pretty much everything I'm looking at within the market. If you guys have anything, think I've missed anything, please do drop a comment. Tell me what you guys are seeing, what you guys think. Discussion is always good. So if you've enjoyed today's video, leave a like, subscribe. If there's anything else, please leave a comment and I'll get back to you. And other than that, have a safe week's trading.